welcome. This is the second year, so we are on session 18, real estate investing. We did a session last year, and this is not the same presentation. Things change a lot. There are a lot of things that, well, we can't cover everything about real estate in one session, and so this one's a little different. And so if you want to review the one from last year, you have access to the recordings when you're a community member of WOW, and also by registering with Wealth Mastery. So, all right, let's get going. So we talked about WOW, and we are co-founders of WOW. I've been in real estate investing for about a decade. So I helped launch the real estate crowdfunding industry. And so I've been in online capital raising, all things related to real estate, from hard money lending around residential assets, so fix and flip, all the way through to large syndication of what's called commercial real estate. So I've had a very broad experience. I invested in my first personal investment property in 2010, before I knew anything about real estate generally, because, we know that, I think everyone knows that real estate is a good way to build wealth, but it's not that simple, and it comes with risk. So in WOW, and maybe Jennifer, I'll let you take this one, because this is really the pillars of wealth and where real estate fits in.
I love this slide because it's something that few people actually learn or know, and it's a humongous problem because right now everyone knows this top of this pyramid, which we call public equities, index funds, etc. What that really just means is the stock market. Almost everyone engages with the stock market because you get into your first job and they offer you a 401k, and they'll talk to you about the time horizon of your risk and about the need to get in early. So we are trained systematically, especially in the US, to participate in the stock market. It is absolutely one pillar of wealth. There's no question about that. However, what happens is we start to think or understand by the signals around us that that is the pillar of wealth. No pillar in money is so stable that it can be the only pillar. It's really about diversification, which they do teach you. Don't just be in stocks, be in bonds. Well, that whole concept of diversification goes beyond just the model of the stock market itself. It also means diversify out of just the stock market, so you're actually stable. And the other two real good corners of any stable foundation in money are real estate and other assets that are, let's call them tangible or not stock market. Just I know I'm trying to make it sound very simple, but it's like, things, maybe gold, silver, a house, a home, something that it's not just paper money that's going to fluctuate. And then the other side is risk management and other financial tools, which is where I tend to lean, because I love the guarantees in those products that have actual guarantees inside of them, which we all know the stock market has literally no guarantees, things like death benefit or long-term care insurance. And when you have an actual diversification that goes beyond just stocks and bonds, that's when you're a lot more stable. I always like to talk about a stool has 3 legs so that it's more stable. It can't just so easily topple over. If you're only on a stool with 1 leg in it, you have to try to balance, and you're not so stable at all. So that's what we call the 3 pillars of wealth, is actually something way beyond just being in stocks and bonds.
Yeah.
And sorry, I did mention this in the beginning, but what the 2 at the bottom of this pyramid have in common is that they fall into the category of, quote, non-correlated assets. Funny enough, non-correlated simply just means they're not tied to the stock market per se. That's literally all that really means.
Okay. Yeah, this is great. So this is where we start everything in terms of building wealth. And so real estate is a giant asset class. It's pretty much, it doesn't get more tangible than real estate. And that's why it's such an important topic. And it's really important to understand some of the nuances of it. So real estate's historically been the #1 long-term wealth building investment. I mean, this is when I say historically, I mean forever and ever, like as far back as humanity goes, right? Like you would defend your home, and people and the wealthiest have always passed down wealth through assets. And just as an aside, the financialization of those assets, so like lending against your home, that's kind of newer, or needing a mortgage to buy a home, that's really newer. So, and also in a lot of other countries, they don't use debt the way we do in the US. So it's very different. But the thing that's the same is real estate. And the savviest investors, so endowments, institutional investors, and ultra high net worth, hold on average between 25 and 30% of their assets in real estate. And that's like their own tangible real estate, not REITs that are traded on the stock market, which I'll talk about in a second. And it fluctuates, but the value of real estate is around 60 trillion. And real estate, like we're saying, it's a tangible thing that everyone understands, appreciates, and considers valuable. And the nice thing about real estate truly is that you don't have to be an institutional investor to own or to understand it. I mean, we just get it, right? Like with real estate, we get it. Last month, we talked about private equity, and we mentioned how investing in commercial real estate is a form of private equity in the sense that when you buy, for example, an apartment building, you'll finance it, you manage it with a view to increase its profitability, and then you sell it or flip it, let's say 3 to 7 years down the line. That's what private equity does for businesses. So real estate is considered a subset of private equity. So this is really important. This is where we're at in the world today. Real estate investments, not just your primary home or a vacation home or like that one apartment that I bought in 2010. Real estate investments are more accessible than ever. And when crowdfunding came along, the Jobs Act was signed into law in 2012, and a lot of things had to happen and change for that to really fully materialize. But when crowdfunding came in, what it did is it created an opportunity to use the internet and internet marketing, which was the new tool, to access more investors and for investors to access real estate investment opportunities that prior to that were really kind of like country club, or you had to know someone. So syndication, so the pooling of unrelated capital together to buy a building, that's always been around. I remember when I got started, I would meet all these real estate people because I'm an entrepreneur. I'm like a tech entrepreneur and brand entrepreneur, and they would say, you kids aren't doing anything different. It's called syndication. And we were like, yes, we are. We're using the internet. And that was really it. So crowdfunding is just a form of syndication, but what it did is it used the tools, the technological tools, to create more access. And this has been like a secular change. And there are some places where you can put in as low as $100 into specifically a building. So imagine like you couldn't buy an apartment building or own a share of an apartment building for $100. This is what you can do today. And generally speaking, whether it's crowdfunding or syndicator, the role of that entity is, in general terms, to find, to vet, and to present the investment. And what we're going to talk about a lot today is due diligence, because even though those entities may be doing it, we still need to do it too. And so you as an investor are passive. You don't control the investment. You don't fix a toilet. You get reports from the syndicator or the crowdfunding company, but really you're passive. You have zero control. So there's pros and cons to that. The other thing, the other secular change that's happened recently is Airbnb. And this is a forever secular, it's not cyclical. This is a forever change in real estate. Short-term and vacation rentals as an asset type for us to invest in, which is very popular, has really taken off. It's its own industry. It's its own subset of the hospitality industry. And so you can, and many people do. I converted a garage into an Airbnb, and so I was a host, and I did the whole thing. A lot of people are doing that. You can convert your garage, but there's also people who have very large businesses where they buy properties everywhere, and then they put professional management in. It's very lucrative. There are some interesting tax breaks. And then there's been, there's other versions of it like Wander and Picasso. So you have like higher end ones. So if you are wanting to do real estate, there's a lot of different ways to invest. Like that's a very active investment. Crowdfunding, very passive. And short-term and vacation rentals, very active, unless you're in a fund, which I've seen. And then the most traditional one is the real estate investment trust. And those are very specific securities vehicles. So they're institutionally managed. And they, generally speaking, are managed by large institutional investors, and they buy very large properties. So a lot of like Class A, like your really nice buildings in New York, for example, or there's a REIT called Ventas, which is all institutional level senior housing. These ones are built in such a way where all of the income has to be passed through to the investor, but you don't get any tax breaks. You do in certain types of syndication, and you do if you're managing your own rentals. In a REIT, you can essentially think of a REIT as a publicly traded real estate stock, in essence. So this is the most correlated to the stock market. So when we think of a REIT, you can think of it as it's real estate. However, if there's a whole stock market route, like if the stock market's going way down because everything's crashing, the REIT will probably crash too, just because the liquidity issue that comes out when everything goes down. So it is correlated very much. And if you find a non-traded REIT, so a private REIT, they're very high fees. So just be aware of that with REITs. But this is the accessibility of real estate. Started with REITs, went to syndication, crowdfunding, short-term vacation rentals. So we have so many options to build our portfolios with real estate today. All right.
Quick question. With a REIT, do you need to pretty much be at institutional level to participate in a REIT?
Oh, no, not at all. They're publicly traded. You can buy them on the stock market.
Oh, wow.
Yeah, that's the thing. Yeah, you can buy them on the stock, but they're managed by large institutions. It's like a mutual fund for real estate, but you can't call it that because it's very specifically built to pass through income, but it doesn't pass through any of the tax breaks, just the income.
It doesn't. So in a way, if you are able to get into crowdfunding or syndication, you get a better advantage these days because you still get some of the depreciation and other tax.
That's right. That's exactly right. Yeah.
Also, there's a question if you had a good experience with your Airbnb garage rental.
I did, and I didn't. I did because we started in 2018, and so it was good. It was great. But it burnt me out because I'm such a control freak. Like I would go in and I'd clean after the cleaners to make sure it was clean the way I wanted it to be clean. And so I had a good experience, but I also put in the work to become like a plus host and all the fancy things that they were doing at the time. It's stressful if that I didn't think about it that way, how much it would stress me out because I just care so much. And so for me, I'm a hands-on person. So overall, it was a really good experience. And now that it's been a few years, I'd probably do it again because, short-term memory and all that. But it's a great way. Here's the thing for me. I liked having the optionality of having it on my property because it wasn't its own financed property that I had to think about. It was extra. It was extra for us. So if it wasn't full, it didn't affect my life. If I'm buying another property somewhere else and it's mortgaged and I have to make sure that the income is there to pay off that mortgage, it's a little different because that has to be self-sustaining on its own or it's coming out of my income. So that's one of the things when you're managing your own properties, whether it's an Airbnb or, you have a rental somewhere else, especially if it's just one unit, is that you have to make sure that the profit and loss statement of that building because you think of it as a small business, you want to stay afloat with that. And I've said this forever and ever, and I'll always say this, don't over leverage, don't take out too much debt, and manage your expenses because those are the things that really get people. And that's one of the number one things that can go wrong with real estate is you take out too much debt.
And I'll add on this page, which I think is really important for women to be learning as we learn about real estate. So because there's so many options now, one thing to balance in your mind as to the equation of that profit and loss is your own time. So for example, we had a member who had this whole house that she owned as a second property, but she had to manage it so much. that at the end of the day, when all her fees and all her time were accounted for, it really wasn't such a profitable investment at the end of the day. Crowdfunding and syndication, or even a REIT, which I don't know anything about, but if you were to choose one and get successful, you wouldn't have to put the time in that you have to put into managing your own property. And that time is one factor, right? Time is money. So it's always good to be thinking about, do you really want to take a short-term vacation rental for your own self? Or would you rather have your time and invest it in something else? But you do give up control. So that's another piece of it.
Yeah, exactly. And that actually really leads into the next two slides. So benefits of investment real estate. So not your primary home, right? Obviously, we're not talking about primary home here. So the benefits of investing in real estate is that you get cash flow from rents or operations. You get capital appreciation and rental income appreciation. Generally, rents go up. There's little to no correlation to the broader market. So that's that non-correlated we were talking about. Historically, it outperforms the S&P 500. And you get well, the nice thing too is you get this diversification. So whether you're using a REIT or you find a crowdfunding platform or a private syndicator or private equity firm, like you can really diversify within real estate quite substantially. You can have different types of asset types or asset and geography. So you can invest in self-storage. You can invest in apartment buildings in Chicago and single family rentals in Florida. You can invest in suburban office or medical office. I mean, retail, malls, like there's so much, like last mile industrial. I mean, there are so many different ways. And this is all made possible because we have so much more access to investment providers, syndicators, and private equity firms that allow us to have that kind of diversification. So investment real estate is an inflation hedge. Generally, real estate outperforms inflation. And because you can raise rents to go with inflation, that's where the income appreciation happens. And we'll talk about variations on that because the last few years have been extraordinary in terms of what's been going on in the macroeconomics and how that's affected real estate. And here's the thing, this is what Jennifer was saying, is that by investing with others, professionals, you can leverage their time, their experience, and their infrastructure and their knowledge, because there are a lot of people that are involved in professionally managing any kind of real estate asset. And then the last thing is that there are tax advantages. All right, and so this slide, what does it take to be a real estate investor? And in this graph, we're seeing barriers to entry on my left, and then the work involved across the bottom. So there's just as many ways to invest in real estate as there are types of real estate to invest into. So the primary question is to ask yourself is, how much time, knowledge, and effort and resources and work can I dedicate to investing in real estate? So the most passive and the lowest barrier to entry are REITs, because you can buy them for whatever the share price is trading at, maybe $20, $50. Now the lowest barrier to entry, but the most active, and by barriers to entry, I just mean money, knowledge, network. Because if you're trying to buy a big apartment complex in Manhattan, I can almost pretty much guarantee you won't be able to on your own if you're a first timer. Like there's just no way. Like there's so many, like this is where the institutions play. So this is what I mean by barriers to entry. Like, do you have $100 million? So that's one of the big things in real estate, is that the types of real estate that were never accessible to non-institutional investors have been made accessible through syndication and crowdfunding. So direct ownership and management of commercial buildings as a general partner, that's very active. You're managing it on behalf of your investors. And then a high barrier to entry, but passive, is private syndication. So that one can have higher entry points, but it's still passive to you. So you're a limited partner, which means you're getting the tax benefits and you're getting the returns that the general partner who's managing the property is gonna pass through to you. So you can kind of see that there's so many different ways to do it, and you really have to think about time, energy, resources, knowledge, and expertise, because there's a lot that goes into it. So here's the really like the meat of what we want to talk about today. As an investor, whoever you're investing with, I mean, it's a little harder with a REIT, but you should still do your research. So I'm not talking about REITs right now. I'm going to talk about your ability to invest with others, like they're called general partners, syndicators or operators or sponsors. Somebody who says, I invest in commercial real estate, let's say, and I'm raising capital, I'm allowing you to invest with me, okay? And for those who are thinking, I want to do my own real estate, these questions also apply to you. So just think about all these questions that you would ask yourself when you're wanting to do something, because some people might want to syndicate. They might want to say, you know what, I want to give it a go. I want to buy a 32-unit apartment complex, and I'm going to raise a little bit of friends and family money, and I'm going to manage it, okay? And then all the way to what has become popularized through crowdfunding and online syndication, which is other people doing that, and you participate as a limited partner, okay? So due diligence goes beyond the IRR. IRR is internal rate of return. It's a way to measure returns relative to other investments. But the point here is that your due diligence needs to be a lot more than just, oh, I like that number, and oh, this one's going to return 25%, and this one's only returning 17. So I'm going to go with the 25, because let me tell you, risk and return is the same in real estate as it is in the stock market, as it is anywhere else. The higher the returns, the higher the risk. You know, this is not like a universal law like gravity, but in investing, it's pretty much a universal law, right? And this is really super important to remember, because this is where everybody goes wrong, especially at the top of the market. All right. So the basics of property acquisition, we're going to start with this because I think this is what everybody knows. I'm not going to spend a lot of time on it, but you know, you need to know the location of the property. You know what you're paying for it, because that's going to set, that's called your cost basis. So that sets your bottom level price. And then your property size and condition. So let's say you're buying a home. These are three things you're going to look at too. Where is it? Location, 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 always important in real estate. Just like you can go wrong. But this has been my experience for a few of the like condos that I've owned, and even our primary residence when we bought it, and even where I live now, we make decisions based on location, based on where it is now and where it's going in the future. So you really think about where a city is growing. And to me, personal opinion, it's worth spending a little bit more in an area that has a better chance of being always an area that will be in demand. Because I always think about, and what we always want to be thinking about is downside protection. What about when, because it will happen, there's a downturn? And what if I have to sell into a downturn? Right. And I bought like the cheapest property in an area where it's like close to industrial, and no, that's going to be really hard to get rid of, especially in a downturn. So I always think about it this way. And I've always been okay in those real estate purchases. And then obviously like price, never overpay for a property ever. Try not to. And this is where the emotions come in. We'll talk about it in a second. All right. So I'm actually going to start with this on the due diligence, because this is actually the thing that very few people ever talk about. And I'm going to show you why, because we're going to talk about all the things that investors are taught to think about and ask questions about. But this is the thing that very few people talk about, which is the market cycle. There's highs and lows in the real estate cycle, just as there are everywhere else. And it's interesting, when I took a real estate analysis course a while ago, and this gentleman who's 35-year vet in doing in commercial real estate and has been teaching for 20 years. And he said, he's like, this is the thing that nobody really talks about, but it's the thing that professionals base all their decisions on. So all this means is like when you look at the curve, you can see that, let's start with the top of the curve. So you have, from a real estate perspective, a demand and supply equilibrium. So you have enough homes or properties coming onto the market for the demand, for the inherent demand. And then you start to see, this is actually when you start to see new construction. We're seeing this in the residential market right now, actually, where you have a ton of new construction because people are not selling their homes. So you have new construction going up a lot. And so this is the top of the market. So you have to be really careful when you're at a top of the market situation, because you could be like a little bit early on the top of the market here, or you could be like here when it starts to slide down. So this is something you want to apply to, let's say, an area, if you're buying something in an area, or like if you're going to invest with somebody, it's like, where are we? And where is this asset type in the market cycle? It always tracks back to macroeconomics, like always. So it goes with job creation, it goes with government spending, like that. There's a lot that goes in it. So we are in an expansion phase right now. Generally speaking, if, for example, in apartments, the most number of new apartments were delivered last year. And at the same time, we still have a multi-million housing shortage. So we still have a lot of people who need and are seeking shelter as renters. And so this is going to go on probably for a few years. And if you look on the stock market, home builder stocks are doing really well right now. And they should be at this point in the cycle. So usually what happens always is there's overbuilding every time, because it takes so many years for something from permitting to hitting the market. Takes years. So there's always going to be an oversupply. And this happened to me when I bought my first condo. There's this, I didn't know any of this. A few years later, oversupply. There were all these brand new, 4 years later, there were all these brand new apartments. And so I couldn't ask the same amount of rent because they could go get a brand new apartment. They can rent there for less. So it's super important. And then you get increasing vacancy because the supply and demand flips. So when it's at equilibrium, it's great. But then when it flips around, it's not. And so as more completions come on, there's increasing vacancy, which looks weird on a downtrend, but it's actually increasing vacancy. And so then that kind of goes into recession. It goes along with an economic recession that the Fed is currently trying to induce. And then when you get to that, then you start to recover. So there's always like a bottom. There's always a bottom. And then you kind of like go again, right? There's a housing shortage. There's still a housing shortage from the 2008 crash, by the way, still in homes and in rental units, because they so overbuilt that home builders didn't touch it for so many years. And they're just starting to come back online now. Think about that. That was 11 years ago, no more, 2008 to now. So the bottom of that recession was like 2010, 11. So about 10 years. So we're finally getting there. So we'll probably see continued new construction for the next several years. All right. Okay, get ready for this. This is what I want to go before we get into the technicals, because this is everything. This is the cycle of our emotions related to real estate, or pretty much anything, but we're talking about real estate. So we're just coming out of the euphoria in a lot of real estate, right? Everybody was in it, everybody was investing, everybody was syndicating, everybody was like, I'm flipping apartments, I'm doing all this stuff. And you never know when you're at the top until it's peaked. You never know, because you can think, just like the stock market, I think about this as a Tesla stock. I'm like, can it keep going up? It must be, it must be the end, it must be the top. And so sometimes you can like hold on and it keeps going up. But if you get in at the wrong time when it's euphoria and it starts to go down, all these emotions, I've been through all of them so many times. And, it's almost like the 10 steps, right? You have anxiety, you have denial, you have fear, you have desperation, you have panic, you have hopelessness. And hopelessness, like that bottom of, I will never invest in this thing again. And especially when that's widespread, you pretty much guarantee that that's like the best time to buy. So I want to start with this because I would like you to check in with yourself as we go through the next pieces, because whether it's real estate or other stock markets, we are emotional creatures. Mr. Market, everything's based on psychology, and then there's computers that trade stocks, right? But everything is based on emotions, and the savviest traders know that. The savviest investors know that, and they live by it's time to buy when there's blood in the streets, right? Be greedy when others are fearful, and fearful when others are greedy. I'm going to call that a universal law of investing, just like gravity. So with this in mind, I want to go into the technicals of due diligence, because we always have to check back with like our cognitive brain and like our intuitive brain, or like our gut brain, right? Like we always want to be checking back and forth. Are my emotions driving my decision? Okay, let's go. So the fundamentals of due diligence are the operator, who's buying and managing the asset, the market, and the property. So the operator, so due diligence is vital. The operator is your number one, like always your number one. I don't care how good that market is or how amazing that particular deal looks. The operator is the person who ultimately is responsible for executing the business plan and getting you your money back and your returns. And most of your risk is going to be with the operator, because the best deal can really go sideways if the operator is not the right person or the right entity. Sometimes the best deals are the ones you don't do. I can put out my hand and say that for sure. Yep. I could have not done certain deals, and that was the best thing I could have done. So it's essential to know what questions to ask different people that are involved with the transaction, and yourself. So if this is you, you're like, hey, I'm going to do this. I want to invest. Okay. So like, these are questions to ask yourself. The projected returns are not the most important piece of information. And in fact, projected returns, probably as soon as the property closes, those are out the window, because they're projections, they're estimates, they're best estimates. Nobody should ever expect that the returns that are projected, unless it's a note, like a bond, that's like a guaranteed payment, unless it's that. And even in real estate, like you can have situations where the borrower is not paying back. But in general, a projected return on something where you're putting in money for equity, it's out the window as soon as the property closes, and maybe even before, because there's so many variables. All right. So
I have a question. Yeah. Is there anything in real estate where there is like a guaranteed minimum return of any kind?
So yeah, kind of. They're called preferred returns, where, but again, it's kind of a best effort. So preferred return is where, like, let's say you're investing with a syndicator, where the investor, the limited partner, is getting let's call it a 7% preferred return before the syndicator splits its profits at the end. So, and this is again like saying that everything is going to go well. So the operator basically says, hey, I'm going to make sure that you as an investor are getting annual 7%. And then at the end, when the property is sold, we make sure that you're trued up to 7% annually. And then after that, it's called a hurdle. After that, we split net profits, 80-20 or 70-30. So when you're in a preferred situation like that, where it's not paying because maybe rents aren't coming in, there's a lot of expenses, that preferred return accrues. It accrues. That's the closest thing that I can think of that is like a guarantee, but there's really no guarantees. And so there's always a loan on it, on a building, like regardless. So that has first position. So in a market when property values are going down, and let's say you have to sell in a down market, then the people who are going to take the hit are the equity. And that's why they're also receiving the higher returns, because maybe your commercial mortgage is 5%, and that's going to the lender, and your equity returns are more, they're more like 12. But in a downturn, but your equity is the piece that's going to get eaten first, because if you have to sell for less, then the bank gets paid back first, and whatever's left over is split. And that's why equity returns are so much higher than loan returns, and they have better tax treatment.
Because they have higher risk. Well, so that, and that's the whole point, right? Like there's risk, you have to understand the risk. And if you want something with guarantees, there are other things for that, but that's not what this is. But it's a much more of a sure bet in a way with the cycles, because even if it takes a really long time, maybe 7 years, it tends to go up. But it's important for people to understand, I think, the cadence for real estate, right? Like it's a solid asset. It might not be doing well unless you really pick a lemon. If you can hold on to it long enough, it can probably go up over time. But it's a question of, is this really going to be like a 2-year guaranteed ROI or anything like that? And it's important to have the tolerance for something that might go longer if you get the timing off, right?
That's exactly right. And I just saw Christina. She's a mastermind member in WOW, and she works in investment real estate as well on the debt side. So you can invest in the loans that are given to oh my God, constructors. I can't think of the word right now, but like people like the developers, and like her company does the due diligence and makes the loan, and then you receive the returns. So that's steady, right? Because if the developer messes up or something and has to sell the property, well, the lender is first in line to get paid back. So and this is where I started in real estate, was there, and it's relatively high interest rate. Again, you're working with developers, so it's higher risk because there's development and there's things that go on. So picking the right operator or the right company that's doing that due diligence and that has the relationship and that has the track record. And I think, Christina, you guys have at least $1 billion that you've done. Like that's a big track record. So we're going to get into this in a second, like when you ask the questions, but so many different ways to invest in real estate. And the closest guarantee is on a loan. Second closest is a preferred return, but again, it can be eroded by market and just poor performance in general. Okay, here we are, the operator. So these are some, you can think of this as notes to take or questions to ask. It's really important to take the time to understand. I just like, it's easy to say, oh, my friend knows what they're doing, and I'm just going to go with what they say because they're better at, numbers, or they understand this better, and I'm just going to trust them. If you're making that kind of decision, that's okay. Just know that you've made that kind of decision. It takes a lot of work and a lot of time to vet and to be comfortable. And it's okay for it to take a lot of time. And it's okay if that particular deal goes out the window in the meantime, because there's always going to be another deal. Like there's always going to be another deal. So this is a lot of work, but it's worth it. So track record and experience, just number one. If you're investing with somebody that is their first deal, you're probably a friends and family. And just know that that's what you're getting yourself into, right? And like I would probably like negotiate higher return because so much more risk. And this is how most people get started. It's okay to give somebody their start. Just know what you're getting yourself into. But always understand their background and their track record and the current state of the business. Like that's really important. So how much AUM is assets under management. So how many buildings, what's the value of those buildings? How many square feet do they have under management or have built? How many assets have they purchased and it's called coming full cycle or full circle or exited? How many finished? How many did they pay people back? How were those returns relative to projections? We always ask like if any of them went completely sideways or failed. Really pay attention to how they answer that. Everyone's going to have projects that go sideways and fail. It's not, I would never expect somebody to have a perfect track record. I think that's a huge expectation. How they dealt with it, what they learned, how they changed their business, like that's all of it. That's really important. So understanding their investment strategy. So what is their expertise? Like, are they developers? Do they do ground up construction? Are they value add? Like they buy something like a 1970s building and they kind of fix it up and they get rents to market. Like they're really good at finding off market properties. Like what is their expertise? And also geographically, what market do they know well? Because just because you know Phoenix doesn't mean you know Dallas, right? Unless you have an office there and you have people there and you have relationships with your brokers there, but also like it's not the same market. So geographic expertise is really important. If somebody's been doing apartments for a decade and then all of a sudden they switch and do malls, why are you doing malls? Why are you an expert now suddenly in malls? Did you hire away two of the best people from the best REIT in malls and you're starting your own thing? Okay. But if you just can't just buy whatever and think you're going to be successful at whatever. It's like to do this right requires focus in so many different ways. And so it's fair to ask why. Why do you think that, so that's a starter. For me, that person's now back to the starting line and higher risk in that asset category, unless they can like really prove that they have some level of expertise there that would make them more successful than the operator who's been doing that asset type for a decade. And then what's their current bandwidth? So this has become very important over the past few years because we had a lot of operators who just overbought. They just bought too many. They were on a tear, on a roll, like so many. I mean, this was like euphoria the past 2 years. Not this year, but like mid 2020 through mid 2022. So what is their current bandwidth and how does that compare with upcoming projects? How are they possibly going to take on so many new projects? Are they hiring enough people? And that's the same for you, right? Like, oh, I'm going to buy all these properties. Well, you need to hire for that. And hiring, just like we know this in business, is like the most difficult thing in the world. Like people are going to make or break every single business, including real estate. Your property manager is going to make or break your property. Truly. And so relationships and references, personal and business background checks, we've learned this very much. Doing those background checks, even if the person seems lovely, all of it, it's worth doing. You ask for professional referrals like their CPAs, insurers, third-party construction companies, maybe even like contractors. You can talk to other investors, especially if they're like a newer, they're maybe a newer syndicator, and just see how that experience went. How have they handled uncomfortable situations? What's their communication like? Like really understanding them as an operator, which goes into the personality and the gut check. Like, do I like this person? Because mostly, especially something like a syndication is going to be about 5 years. That's not a short amount of time. And so how do they communicate? Do you get a good I'm serious about this. Do you get a good feeling from this person? If you don't, walk away. Doesn't even if it turns out to be a great deal and you think, God, I really should have invested in that, but he just wasn't my person. That is totally okay. You have to honor that. And notice whether there's whether that gut check is truly about that person or if you're freaked out about something else and kind of try to understand what that is, right? You might meet a person and you have an impression that could be researched to understand okay, actually I'm okay with this person, but you got to do your research on that. There's always a level there of professionalism, openness, accessibility. They don't have to report every single little thing that's happening every day. I mean, there's so much work and you don't want to know every single thing that goes on, and you're not supposed to. They're doing their job, right? But they should be communicating on a regular basis and giving important and pertinent information. And then is the incentive structure aligned? So how are they making money? And how are you making money? Do they put money in the deal? They should. And especially if it's equity. So ask them how they're being paid. Check where they're taking fees. Check yourself. Are you trying to take a bunch of fees? Because you can. Because again, at the height of the market, there were a lot of operators that they actually dropped their preferred return, and they had these double layers where, let's say they dropped the preferred to 6, because this is supply and demand. There were so many investors that wanted to invest that people got greedy. So they dropped the pref, and then they said, well, if we make better than 15, so we'll drop the pref and then we'll split it 70-30, let's say. So 70% to the investor and 30% to us. But if we make more than if the return is more than 15, then we split it 50-50. Well, that's just greedy. That's just greedy. There's no need for that. So portfolio analysis, review the current portfolio of assets, including historical financials and pro formas. Now, I'm saying all of this, sometimes as a limited partner, you don't get access to all of this. If you're working with a private equity firm, they do this. This is what they do. So you might not get access to all of this, but you should ask them, did they do that? Did you want to make sure that they did that? Right? If you're working direct with an operator, depending on the size of the operator, you should be able to do this. If you're syndicating, you should definitely do this. Like, you should definitely be the one to get this information, do multiple site visits. And also, again, did the private equity or the syndicator do site visits? How is the portfolio managed and how is it performing? And then another one is reporting. So how are they reporting? Do they have an investor portal? Is it in Excel? Is it on the back of a napkin? Reporting, like, I go back to the property manager here because they get property manager reports. And I'm putting property manager under here a little bit because they go hand in hand. Sometimes the operator is their own property manager, has their own property manager in-house. Other times they have a partner that they work with, or they're buying, and so they place that property manager in the new property. Sometimes some people will keep that property manager. So the strategy is highly dependent on the property manager. All right, so I'm just going to go through this one super quick because it's important, but I want to get to the next slide. So when we think about the market, it's what are the adjacent property values? So it's called comps. How's the labor market doing? How's the local economy doing? Basically, what's the neighborhood like? What are the tenants like? And this goes for industrial just as much as like retail as anything else. Like if you're investing in a mall, what kind of mall is it? Where's the mall? Who are the anchor tenants? Like how are they doing? You want to look at rental rate trends. So this goes back to like what part of the market we're at in the market cycle. And then property supply and demand. Like, are there a bunch of new builds coming up? Is it actually really in short supply? And this is kind of location, but really drilling down into location. And there's a lot of macro analysis here. So this is a really big piece of it where you want to be pulling stats and you want to be pulling reports and you really want to understand the numbers and try to ascertain where in the market cycle this area is and how the property is going to perform short, medium, and potentially long-term, especially if it's a long-term hold. The property, so the deal is the third and very, very important piece of this. So I have loan and financing twice because it's so important. It's so important. This is where a lot of operators and syndicators have been caught, and a lot of investors are losing or will lose money in their investments that they made because some people were doing this strategy, which was like a 2 to 3 year strategy, but really like 2 years or less, where they would buy apartments. They would use floating rate debt. So that means a variable rate debt. And when the Federal Reserve raised interest rates by 5% in a year, that floating rate debt suddenly was extremely expensive. And all of the free cash flow from the properties went to pay off debt. And sometimes it was not, and it's still not enough. So remember what happened in 2008 when everybody used ARMs to buy 3, 4, 5 homes, and then all those loans got called back? This happened in syndicated apartment real estate in the past couple of years. So the debt is so important. And I was talking to a colleague of mine in the space, and he said, I have a rule, because he's actually like a commercial mortgage lender. And he said, I have a personal rule that I broke, which is I never invest in variable rate debt based projects. Again, euphoria, everybody's doing it. It's going great. They exited really well. I want those returns, whatever it is that we tell ourselves. So we got to go back to the emotions. So always asking about debt service coverage ratio. It needs to be at least 1.25. So that means that there's enough cash flow to pay off the debt by at least 1.25 times. When you go under, your net negative cash flow. So if you can't pay the lender back and you don't have a lender that will work with you, that lender is going to take the keys and everybody loses their money. That's where that equity piece, pref or not, is gone. So this is one of the things that's hurting a lot of people right now, and how the transaction is being capitalized. So that means, again, how much is the loan? Like, is the loan, this is like LTV, like loan to value, like the loan, how much is the loan relative to the price of the asset at purchase? What's it relative to the total financing? These are super detailed. So I'm just saying, like, be really super hyper aware of the loan and the financing. Generally, fixed rate debt, it's like your 5% or whatever for the whole time. That's great, because you're not going to have any surprises to the interest. And rate caps are a really big thing now. So a lot of the, these 2-year strategies, some people did and some people didn't. They're called rate caps. So thinking ahead, hey, the Fed's going to raise rates. Let me buy from the lender prepay points so that I don't have to pay more than, call it 3% above. And that rate cap expires. So another thing that's happening is you have a lot of buildings where the rate cap is expiring and they have to buy it again. And guess what? It's way more expensive, like millions of dollars instead of like a couple $100,000 that it was 2 years ago. The financing, this is a lesson learned for a lot of people to really pay attention to it. We've talked about on-site management, the pro forma, tons to review in the pro forma. Find your smart math friend if it's not you that knows how to read a pro forma and understand it. Take a class, talk to peers. It's really important to understand. The pro forma is like the business model, like, how much do they expect to raise rents? Like, how, is that reasonable? What are the comps? Like, how much are they going to spend on construction if there's renovations? Like, this is super important. It's highly technical. And then property specific. So we kind of covered that with market. So where the property is in the market, the condition, is it a 1970s building that needs a lot of work? Is there a bunch of new build coming in at the same time? How are you going to raise rents to match? Like, there's a lot that goes on. So in other words, how competitive is the property within the market? Say legal documents as an investor, get a PPM. So that's a private placement memorandum. That is a much bigger document that outlines a lot more risk, responsibilities. It's a really important document. It's a big read, but it's worth reading. Don't just get an operating agreement. Like, this is where you see the professionalism of, did they work with lawyers? Did they spend the money to get documents done correctly? The waterfall is the fees. So we talked about that a little bit with the operator. Capital call. I probably don't have enough time to go into this. Capital call is happening a lot. So this is where, and almost every PPM has a capital call provision. So this is where, when the operator goes back to investors and says, hey, we need more money or we're going to lose the building. This is happening a lot right now. And that goes back to reviewing the PPM and reviewing the pro forma and reviewing the business plan. This is a make or break moment, capital calls right now, for the syndicators. How they handle it, how they handle investor communication. My belief is that some syndicators and some operators will come out the other side a lot stronger because of how they handled it. And then a lot are going to fold because it was poorly handled. So it's really important to read the legal documents. All right. Jennifer, I thought of you a lot when I was doing this one, because risk, that's your world. I would say number one, they're going to go wrong, right? And don't freak out. Don't find someone to yell at, and just don't blame or shame yourself. When you're in that emotionally, right? Going back to that emotional slide, Just be sure. And I do this for myself. I'm speaking as myself, where if I'm emotional and I'm getting an investor communication and I just want to fire off an email or, go eat something in the fridge because I'm so emotional. I go back and I chill out. And then maybe like a few hours later or the next day, I will reread it and make sure I understand what's going on. Because as an investor too, it's important because I'm on both sides of this equation. I've been on both. There are investors who clearly did not read anything and they're lashing out, and that doesn't get anyone anywhere. And then there are those that say, hey, can you explain this to me? I need to understand this a little bit better and we can have a civilized conversation. This is really important for the relationship all around, even if you're really mad. It's just so important. And then that leads to trying to understand the reason for the issue. Is it the loan? Is it financing? Is it the market? Is it something completely outside of their control? Like I'm in something where the insurance went up 300%. And the underwriting had 100%, which they thought was twice as much as it could go up. And insurance is a killer right now in real estate. Like it's just going up like crazy everywhere. And so nobody ever thought it would go up 300%. Nobody thought the Fed would raise rates 5% in a year. So what's the issue? Or is it, negligence? That's different. That's a whole other ballgame. And then if you really want to do more work with it, look at data-driven research. Don't read the social media. Don't read the forums. Don't do that. What is actually the reason? Because let me tell you, over the past, like even just 9 months, so much has changed in the markets. Rents were still going way up when the Fed started raising rates, and then they started coming down. So every month the media headlines will change, but the data will also change. So it's just really important to understand. It helps you also calm that emotion down. Schedule a call or attend the webinar, because there's so much information provided. We need to, as investors, understand. We need to understand ourselves emotionally. We need to understand what we got ourselves into. We need to understand a lot. It's a lot of work. And determine the impact of the investment's non-performance on your portfolio. Did you put 50% of your investment portfolio in something you did not understand? I mean, it could go really right and it could go really wrong. Did you, I do this too. I'm like, oh, this one's not going well. Well, that's only 4% of my portfolio, right? That's why we diversify. And are the issues temporary? Is it just a temporary pause? Is it a capital call? Is it going to be a total loss, right? Like these are important, and you have to go back to your portfolio. Am I safe? Do I have a bunch of money in guaranteed investments like the ones that Jennifer works with? Well, then this was my real estate kind of like, not play money, but like this was my real estate portion and it has risk. And I knew that, but I feel really safe over here because I have my foundation. Also speak with your CPA, especially if it's a loss scenario, because there's tax benefits to that. It's not the best thing in the world, but it's better than nothing. Like, is there a tax benefit? Do I get a capital loss? And then go back again and review your own risk tolerance. Maybe you're more risk averse than you thought when it's going down. I know I am. I'm like, I really don't like losing money. So maybe I shouldn't take that much risk, right? And then we do this constantly because we change and we grow. And as investors, the more we learn and the more we have experiences, the more we learn about ourselves so that we make better decisions the next time and then make adjustments. All right, so I know we're like way over. So real estate is a long-term, and generally illiquid asset. You don't get your money out until it sells. So be prepared for market cycles and different outcomes than the projections or people's best efforts and your expectations. You can diversify within real estate, and there's a lot of real estate strategies and providers, so don't get FOMO and don't get spooked right now, because there are some great opportunities right now because of what's been going on. So real estate belongs in every investor's portfolio, but it doesn't come without risk. All right.
Yeah, my gosh. I know we went over and I'm glad we
All
did.
right.
So much information here. I hope everybody here could feel it too. This is like a master class, really a speed masterclass on a really complex subject. And I want to thank you because I know how much passion and experience you bring into this. And so honestly, you were just dropping pearls left and right in all of this. People can reread, rewatch this, and also people can always reach out to us in Women of Wealth. I hope you've enjoyed this. I hope you've gotten a taste for what we're looking to do in WOW. We know that Leadership Global is an incredible forum for all of us as executives, business women, and just working women as a whole. We in WOW focus granularly on the financial piece, about the piece that specifically deals with growing our inner and outer personal and financial abundance. And if this is something that's up your alley and you want to nerd out as much as we have here and more, you can join our community in cost. So we have a mastermind, which is an intimate group, typically about 30 of us total. So very few spots left in that, but we are always open to meeting new amazing women who want to be in our mastermind. You can check out how to join the mastermind on our website. And we have supporting member tier for those who maybe aren't ready to be in a mastermind and all of the workload of being that intimately involved, but want to stay in this community and orbit and have these conversations, learn what we can share. We distribute a lot of really valuable information, a la what you just experienced today within our community. And that's a very easy way for you to continue growing your abundance IQ. You can also check out www.womenofwealth.com. It's an XWOMXN of wealth.com to become a supporting member. And remember, if you're already a Leadership Global member, you absolutely get a discount for joining WOW. And it's a really easy way to commit to growing your own personal abundance. And of course, if you're with any kind of organization that wants to support moving the needle for women all across the country and the globe, we are always open to partners and donors as well. So please feel free to speak with your employer or your place of business and see if they would like to partner with us or contribute to what we're doing. We have many, many exciting programs, including our financial citizenship program, which helps educate children as early as 2nd and 4th grade, all the way through middle and high school, so that they learn that the M in STEM stands for money, not just math, and helps move the needle for all traditionally disenfranchised people, not just women. And we also, of course, have our Abundance IQ curriculum. So lots going on at WOW. Feel free to join our orbit. We appreciate all of you coming. And I will read our closing information for WOW. You can always join us every month here at Wealth Mastery for more thought-provoking discussions about financial strategies and tools and products and practical takeaways for building a healthy financial foundation and for building generational wealth that's aligned with your personal goals and values. Make sure you register for next month's session. I can't remember what it's going to be about next month. I'm blanking.
It's venture and angel investing. Talk about risk.
Another exciting topic, and one where we have so much to share about that. So I hope that you'll join us again. And remember, if you want to be part of this trusting community of leadership all around the world, just reach out to Leadership Global and or WOW. We are so glad that you were able to join us today.
Thanks, everyone.